Welcome to this week's analysis. Today is January 29th, and we have a volatile week ahead, to say the least. Not only do we have the Fed meeting on Wednesday scheduled for 2 p.m., we also have the JOLTS job openings on the same day, and we have 5 big tech names reporting earnings this week. But before we get into that, we need to talk about what happened last week. Last week on Thursday, we had Tesla earnings come in at $1.19 versus an expected 98-cent earnings per share, and then the revenue ended up coming in at 24.3 versus 24.3 expected. So they ended up beating on their earnings per share, and it was a very small beat on the revenue, but the key was that they kept their 50% guidance. And if we look at the statement that they gave for their guidance, it did seem a little bit shaky compared to the year before. So in the report for the outlook, it says, in some years we may grow faster and some years slower, depending on a number of factors. For 2023, we expect to remain ahead of the 50% CAGR, or compound annual growth rate, with around 1.8 million cars for the year. And this is compared to 1.3 million the year before in 2022. So that would be 500,000 over a 1.3 million delivered in 2022, which would actually be a 38% growth rate. So I'm not sure why they said that they expect to remain ahead of the 50% CAGR, but it is what it is. Maybe one of the executives fat-fingered and doesn't understand how to do math. And if we compare this to last year, they said that over a multi-year horizon, so basically they're saying the same thing. We expect to achieve an average of 50%. So that means that they could do worse, they could do better in some years. And the rate of growth will depend on our equipment capacity, operational efficiency, and the capacity and stability of the supply chain. So they're not experiencing the same supply chain issues that they were in 2020 according to their outlook, but now there's a myriad of factors is what they're saying, depending on a number of factors. So it could be the interest rate hikes destroying demand for their high-priced vehicles. It could also be the low supply of lithium and how we depend on China for lithium. We really don't know. They didn't give us any specifics on it. But the next company that reported earnings was Intel, which was a huge miss on their earnings per share. They ended up coming in at 10 cents earnings per share when they were expected to do 20-cent earnings per share. And their GAAP earnings per share, which doesn't account for any stock buybacks or for any employee stock compensation, actually came in negative, I think for the first time since 2008. So considering that they had a negative earnings per share, GAAP, and their non-GAAP earnings miss so poorly, we could be seeing a destruction in demand for chip makers, which we have another chip maker reporting earnings, AMD, this week, but we'll talk about that later. But they were down by 6.5% on Friday, whereas Tesla for this week was up by 31%. And finally, the last big piece of data that came out for this week was GDP, coming in at 2.9 versus 2.6 expected, and this is actually down from 3.2 the quarter prior. So the story behind GDP is that it came in positive, which means that we're not going into a recession. But if we actually look back on this, it came in at 2.9 for the year-over-year growth, and if we compare this to 2021, obviously an unusual year because of the massive stimulus, this came in at 7%. So GDP is definitely slowing down, which could lead to stagflation, where we see a reduced growth in the economy while still experiencing high inflation. And those were the big stories for this week: GDP, Tesla earnings, and Intel earnings. So let's get into the big stories that are coming up for next week. So the big event that's scheduled for this week is going to be the Fed meeting at 2 p.m. on Wednesday. So you have the rate hike decision on whether this is going to be a 25 basis point rate hike or 50 basis point rate hike. So basically, this is in the bag that we're going to get a 25 basis point rate hike. And if the Fed decides to go with a 50 basis point rate hike, this will be the first time in about 60 years. So the Fed has basically always followed the Fed futures, and if they decide to go against it, that would be absolutely terrible for the market. And then at 2:30, you're going to have Powell coming out to speak to the press. And all ears are going to be on what Powell has to say and the tone that he gives during his speech. So you have a hawkish tone to where he's more in favor of continuing to raise interest rates higher. And then you have a dovish tone to where he might allude to decreasing interest rates sometime by the end of the year. And that's exactly what the markets want. If we go back to the FOMC watch tool, the Fed futures are actually expecting them to cut rates in November of this year down to 4.5 to 4.75%. From September, it's expected to be 4.75 to 5%. And almost every time that we have these Fed meetings, you'll see a shift in directions for the stock market from the 2 p.m. rate hike decision to 2:30 whenever Powell starts to speak. So if you see the markets rallying on the 25 basis point rate hike, chances are that it's probably going to fall. And then in the opposite direction, if it's super bearish after 2 p.m., then it might turn bullish at 2:30. And in the beginning remarks that Powell gives at 2:30, you probably shouldn't pay much attention to that unless he says something that's way different than what the markets expect. You should really be watching for the question and answer that's towards the end of the meeting. And on the same day that we're getting this huge Fed meeting, one of the most important Fed meetings of the year, as it always is, we're also going to get the JOLTS job openings in the morning. So this is going to tell us how many job openings there are versus how many people are unemployed. And the expectations is that there's going to be 10.2 million jobs that are currently available versus 10.46 million in the last month. And this is down actually from a peak of 11.8 million jobs available in March of 2020 compared with 1.5 million people that were unemployed at that time. And now we have 1.7 million people unemployed. So right now we have 6.8 jobs available per unemployed person, according to this data, versus 7.9 jobs available per person that's unemployed in March of 2022. So the number of job openings per unemployed person is down by 14% since the Fed started to raise rates in March of 2022. If this number continues to come down, that means that people have less jobs to hop back and forth to and continue to ask for higher wages. So this will work against wage inflation and overall inflation. If people have more money to spend and there's the same amount of goods, then prices are going to go up. But if people have less money to spend because they can't continue to ask for higher wages, then inflation will end up coming down. So that's the JOLTS job openings, the Fed meeting, both scheduled for Wednesday. And then we have a lot of volatility to be expected in big tech with Amazon, Apple, Meta, Google, and AMD all reporting earnings this week. So we have Amazon that's reporting earnings on February 2nd. It's expected to come in at 19-cent earnings per share and $145 billion in revenue. In last quarter, they did 20 cents in earnings per share and $127.1 billion in revenue. So the revenue is expected to go up by almost $20 billion, and their earnings per share is actually expected to come down a little bit. And if we look at a year ago, they were doing the same 19-cent earnings per share, and they were doing $137.9 billion in revenue. So this means that they're expected to be stagnant in their earnings per share, but they're expected to go up 5% for their revenue year over year. So this means that their margins are expected to come down by about 5%. And I don't think that their margins are only going to come down by 5%. I think it's going to be probably more just because of the high wage inflation that they're experiencing. And finally, if we look at historical data, this is really bad. They were doing 56-cent earnings per share on average for the last 2 years or the last 8 quarters, and their historical revenue has been $119.9 billion. So they're expected to do about $20 billion, $25 billion more dollars in revenue this quarter, but their earnings per share has been more than halved. And if we look at Apple, also reporting on the second, they're expected to come in at 1.93 earnings per share, $122.1 billion in revenue. And in the last quarter, they did 129 earnings per share and $90.2 billion in revenue. But the fourth quarter of each year is always bigger than the previous quarter because of seasonality and people buying iPhones for their relatives for Christmas season. But considering that retail sales were down so much for December, this might not be the case. Last year, they did $2.10 in earnings per share, $124 billion in revenue. So they're expected to do 8% less in earnings per share and 1.5% more in revenue this year. So this means that they would see a drop in margins of almost 10%. And if we look at historical data over the last 2 years, they did 147 earnings per share on average for the last 8 quarters and $96.3 billion in revenue. Next, we have Meta, which is actually reporting earnings before Apple and Amazon on February 1st this week. And this is expected to come in at $2.32 earnings per share and $31.8 billion in revenue. If we look at the prior earnings per share revenue, it was $164 last quarter and $27.7 billion in revenue. And last year in the same quarter, it was $367 earnings per share, much higher than it's expected to come in this quarter, and $33.7 billion in revenue. So they're expected to come in lower for both the revenue and their earnings per share by negative 37% for their earnings per share and negative 6% for their revenue. So Wall Street is expecting a drop in their margin of over 30%. And historically, over the last 8 quarters, they've done $306 earnings per share and $28.8 billion in revenue. So they're expected to do a little bit better in revenue and very much worse for their earnings per share. And after we have Meta on the 1st, we actually have Google on the 2nd, which is actually going to be a sympathy trade. So a sympathy trade is whenever one stock is in a similar category to another stock, which means that they usually trade hand in hand with one another. So if Meta earnings comes in really bad, then Google is expected to come down. But if Meta does really good, then Google will go up. And Google is expected to come in at 117 earnings per share and $76.7 billion in revenue versus last quarter 106 earnings per share and $58.4 billion in revenue. And a year ago, they were doing 153 earnings per share and $61.9 billion in revenue. So they're expected to come down by 24% in their earnings per share and actually do 24% better in terms of the revenue. So this is almost a 50% cut that Wall Street is expecting in their margins. And historically, they've done 128 earnings per share over the last 8 quarters and $53.6 billion in revenue. So they're expected to do much better in revenue and again, worse in their earnings per share. So the big story here is that Google and Meta, these big software names, are expected to see a huge cut in their margins. And finally, the last report of the week, which is actually the first report of the week. On January 31st, we have AMD, which is expected to come in at 67 earnings per share and $5.51 billion in revenue, compared with 54 earnings per share and $5.57 billion in revenue last quarter. And a year ago, they were doing 83 earnings per share and $4.83 billion of revenue. So year over year, they're expected to do 19% worse in their earnings per share and 14% better in their revenue for a cut in margin of over 30%. Historically, they've done 71 earnings per share and $4.71 billion in revenue over the last 8 quarters. And if Intel is any forecast to what AMD is going to report, then I think that this could be really bad. But the thing about AMD and these big tech names is they can make their earnings per share look like however they want, because you have GAAP earnings per share and then you have non-GAAP earnings per share. So non-GAAP earnings per share, they can write off things like employee stock compensation or share buybacks, which these companies have come up with a lot of cash over the last couple of years. So they can buy their stock back and boost their earnings per share. And they can also give a crap ton of shares away to their employees instead of giving them actual pay. So this gives these big tech names actually leverage to do better on their earnings per share and give Wall Street whatever they expect. So those are all the big earnings that are scheduled for this week. 5 big tech names, going to be extremely volatile. Now let's finish off with technical analysis. Last week, SPY ended up crossing above the quote-unquote mother of all trend lines, which started at the top of the bull market and has been descending ever since. We ended up crossing this trend line on January 23rd, and we haven't looked back ever since then. But if we're looking at the RSI, we're actually starting to see a little bit of divergence compared to the most hated rally between June and August of last year. So right now we're at 63 on the RSI compared to over 70 on the RSI before, when we were trading at much higher prices than where we are right now. So usually RSI divergence like this is a negative sign for the stock market, but only time can really tell. And the expected range for SPY this week is actually pretty tight. We're only expected to go up or down by 2%. According to the trade tab over on Thinkorswim, we're only going to go $8 in either direction for this week. Considering the FOMC meeting on Wednesday, I would expect a lot more out of this week, but that's what the markets are telling us. But we've got some important supports at 403.38, 400.36 from the hourly chart, $395.25 from the daily chart. And then for resistance, we have the 408 level that we got rejected by on Friday. Then we have 411.02. And then we have the most important resistance at $418.21, which is the Fibonacci that stems from the bottom of the COVID 2020 crash to the top of the bull market at the end of 2022. And then the most important support level that we have is all the way down at $380. So definitely be looking out for those numbers, 380 and 418.21, but that is well outside of our expected range for this week. For AMD stock, the one that I'm definitely going to be trading that I already have open positions in, we have a divergence in RSI, just like with SPY, but this time we had 70 RSI in the last rally, which ended in early November. Currently, we're trading at 62 on the RSI and almost 10% lower in terms of price action. And the expected range for this week is between $69 and $81. We have some supports at 73.29 from the hourly chart, 71.54 from the daily chart. We have 69.09 for the hourly chart and 66.91 for the daily chart. And then for resistance, we have 76.70 and 79.20. And then outside of the risk range, we have a support at $66.91 and a resistance at $83.46. So if there's more volatility to come from AMD, then expect to see these two price levels. Next, we have AAPL, the big old Apple. We have the obvious resistance at $150, that big psychological number. We have 147 as a resistance, and then outside of our risk range, we have 157.64. And then for supports, we have 142.53, 139.50, and outside of the risk range for the support, we have 135.20. And the risk range for this week, or where Apple is expected to trade between, is $139 at the bottom and $153 at the top. And if we're looking at RSI here, this is extremely high at 67.9. Compared to the last rally, this only went up to 60. So we're not seeing diverging RSI for Apple, but it is extremely overheated at 69, but that doesn't necessarily mean that we're going to sell off as soon as we hit 70 RSI. The way that RSI works is if it's above 50, then we're bullish. If it's below 50, then we're bearish. Overbought and oversold almost mean nothing. And finally, the last stock that I'm going to be trading this week, is going to be Google, hoping to get into this before Facebook or Meta, I guess, reports earnings on the 1st. But the expected range for this week is between a bottom of $95 and a top of $107. And then for supports, we have a 95.91 price level, 99.18, 93.91 outside of the risk range, and then 91.65. And for resistance, we have 101.19 from the hourly chart. We have 103.02 for the daily chart, and then we have 106.40 for the daily chart. And finally, outside of the risk range for resistance, we have $113.50. So those are the price levels to be looking out for. Those are the three stocks that I'm probably going to be trading this week: Apple, AMD, Google, and of course going to be keeping my ear to the ground for whatever Powell has to say. Hopefully you'll have a great trading week ahead. Thanks for making it all the way to the end of this video, and thanking all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.